Hello, welcome back. Here is Ali Talabi, and this is module 15. In this module, we're going to talk about the IPO, initial public offering. Also, we'll talk about going private. So let's start our module. Now, let's assume that you are going to launch your business. You have a great idea and you know that it's going to work. So you are going to establish a new corporation or business. Now, in this case, what is the financing process? Usually you start with the love money. What is the love money? You use your own money and then you go to your relatives, your dad, your sister, your cousins, your brother. So you ask them to provide you some money for the business, and most probably they will offer you the money because they love you. So that's why we call that love money. So you start your business, and for sure, after a while, you need to develop your own business. In this case, you will need further money and you will go to angel investors. Don't forget that in the first step, for sure, you have the chance to borrow the money from the bank. However, there might be some major restriction. Maybe they're asking for a business plan, or they want to see some progress in in your investment. So it might be kind of challenging the first step to borrow money from the bank. Anyway, when it comes to angel investors, we're talking about those individuals who have money. They're looking for the great ideas to invest on, and mainly we're talking about the individuals, not the firms. And they are providing some money to you, but in exchange, usually they're asking for the part of the ownership of the company. The money you can get from there is not that much. It's kind of limited. So you might consider the next step, which is the venture capital. Now, the venture capital firms or the companies, they are much bigger than angel investors in terms of the funding, so they can provide you much more money. However, remember, you need to have a kind of prototype, or you need to have a kind of the product or service in place to some degree to go to them. So you cannot go in the first place to VCs and say, you know what, I need this money, but I have a great idea to work on. Usually they're asking for some kind of proof. For example, if you watch in Canada, we have the show which is called Dragon's Den. So if you watch the show, it's actually the same case. You go there, you pitch your idea, and you ask the investors, the VCs, the venture capital firms, actually to provide you the money. And finally, let's assume your business now is expanded, developed, and you are at the stage of going public. It means you are going to sell your shares to public investors. Now, that's a process which is associated with IPO, initial public offering, and then we'll talk about the SEO, which is seasoned equity offering. So, and in this module, we'll talk about IPO a lot. So, let's talk about the rest of this presentation. So I mentioned I'm going to talk more about the IPO, initial public offering. So it's a kind of long journey when it comes to IPO. First, you need to choose the underwriter. And there are several aspects of choosing the right company. There are several terms and conditions, and I'm going to talk about some of them in this module. Then you need to prepare a prospectus, and I will mention what is the prospectus. That's a kind of the short summary of the information about your company, your business, your activities, and for sure your financial statements. We'll talk more about prospectus later. The third step, you go and talk to the potential investors who are interested to invest in your company. So they're interested to buy shares of your company. Now we have the terms oversubscription, undersubscription. Oversubscription means that actually there are more demand than the supply. It means that you estimate that you are able to easily sell all of your shares. For example, if you are selling 1 million shares, there are more than 1 million actually shares you expect to sell. So that's oversubscription. You love that happened. However, you might end up with under subscription. It means that you might end up selling less than what you estimate or you want. And for sure, one of the major decisions you have to make in this journey is choosing the right secondary market, or choosing the right stock exchange. So you have several options, and we'll talk about that as well. Now, we talk about choosing the right underwriting company. So if you look at the most of investment banks, so actually most of commercial banks, they have the investment banks as well. So you need to approach them. You need to get some help from them. They help you actually to in this process, in the process of going public. So they provide you some marketing tools, they provide you some financial advice, and for sure, in exchange, they're asking for commissions. Now, you have to see that in some cases, when we're talking about the big giant corporation, when they want to go public, in this case, the investment banks, they usually form a syndicate, which is a combination or collection of several underwriters, because they want just to distribute the risk. They don't want to take the whole risk together. Usually, there is a one lead manager, and there are some other underwriters, and they do this big giant underwriting. I mentioned one of the major conditions in the agreement you are signing with these underwriters is the form of the underwriting. We have two major forms of underwriting: the firm commitment and the best efforts. What's the difference? Under the firm commitment, that investment bank, the underwriter, is committed to sell a specific number of shares. Let's assume that the underwriter is committed to sell 1 million shares. What if he's not able to sell those many shares? In this case, he will buy the rest by himself. So you don't need to be concerned even if the underwriter is selling, let's say, 800,000 shares in the market, he will buy the rest 200,000 shares. So that's a very kind of peace of mind for you, because you will be confident that you will sell all your shares with a specified price. The best efforts: if the underwriter is not sure that he's able to sell the whole number of shares, he goes with the best efforts, which means he tries just to sell as many as possible, as many as the higher number of shares. However, there is no guarantee, there is no commitment in this case. So let's say you're selling 1 million shares and he's able to sell 500,000 shares. Just you will receive the money or funds just for the shares which are sold. And remember, under both scenarios, the underwriter is going to receive a spread or a kind of commission from you. And we'll talk about this further. So this is not a kind of easy process for sure. There are many steps you have to follow when it comes to going public. However, the major portion is regarding the cost. So the costs which are associated with selling new securities or shares to the public investors is called flotation costs. We have two major types of flotation costs: the direct ones and the indirect ones. What's the direct ones? The direct is more specific. So we're talking about the commissions you have to pay to the underwriter, the legal fees, the accounting fees, some administrative costs. These are the direct costs. However, most of investors, maybe they actually ignore the indirect costs. What is the indirect cost? That's the opportunity costs, which are associated with selling your shares. In very simple words, it means that you could sell your shares maybe in a higher price. For example, let's assume today is the IPO date. You are selling your shares to the public investors. The selling price is set to be $10. You are selling $10 your share. However, you notice at the end of trading day, the stock price went up to $15. What does it mean? It means actually you could sell your shares at $15, but you just sold it at $10. So that $5 difference, that's the opportunity cost. That's the indirect cost where you should consider your total flotation cost. So I mentioned before going public, you have to consider the formal document, which is called prospectus. That's summarizing information about your company, the financial aspects, the market aspects, operation, and whatever is related to your company should be listed. Doesn't matter; those are the positive or the kind of the downside of the business. So also you need to list all the risks associated with your business. So in the next lesson, we'll talk more about listing on the stock market, and also I will talk about going private. Till that time, have a wonderful day. Take care. Talk to you soon here as Ali Talavi.